Today's topic is about
insurance,
hydro savings account,
the differences between index funds, mutual funds, and ETFs.
But how this TikTok star makes so much money.
Tip number 10 is do not share your credit card information with anyone.
First, we gotta decide how risky we want to be.
So this contact spreadsheet, everything spread.
Any of these videos look familiar? There's been a rise in personal finance content. More and more people want to learn about managing and making money. We've actually made an article discussing finfluencers on TikTok. We'll leave the link down below if you want to check it out. Do you want to live a good life and make easy cash money? Do you want to get rich quick? Well, say no more, because this is not the video for you. Nope, you didn't mishear that, because in this video series, we don't promise to make you rich. We're here to help you become more financially independent. Welcome to the Pisopedia playlist. So what exactly is financial independence? Financial independence basically means freedom. A lot of people say that money doesn't buy you happiness. We're not saying that's wrong, but having money does allow you to do a lot of activities you want to do, like playing your favorite sport, going to a concert, or building a collection. It also lets you buy both your needs and your wants. This is the freedom that financial independence affords you. How hard is it to be financially independent? Some people might think that it's simple. You save and invest your money. Well, it's not really that simple. There are many factors that can affect one's ability to reach financial independence. In this episode, we will be giving some straightforward advice and helpful principles to help you work towards your financial goals. While the journey in financial goals may be different for everyone, know that financial independence isn't about how much you make, but how much you save. Financial independence sounds pretty great, but where do we begin? The answer is financial literacy. Financial literacy entails having the necessary knowledge to make informed financial decisions that are aligned with your goals. Side note, you might be thinking that people with more resources don't need to be as careful. But I'll tell you now that even celebrities with lavish income aren't safe from the consequences of financial illiteracy. There have also been similar stories of famous athletes and other well-known personalities. Let's break down financial literacy into this quick checklist. First, you make informed decisions with your resources. Second, you're aware of available financial options. Third, you have a financial plan in order to reach your financial goals. And fourth, you see the value and importance of money. There are many aspects to financial literacy, from earning money, budgeting, investing, paying debts, getting insurance, to managing your expenses. But for this video, we'll be keeping it simple. We'll focus on saving, investing, and some general tips to help get you started. Saving is actually the prerequisite to investing, which we will go further into later. The reason people find it difficult to save is because it's a common practice to follow the income minus expenses equals savings equation, when it really should be income minus savings equals expenses. Saving and budgeting can sometimes be a stressful experience, especially if it's not something you practice consciously. But it doesn't have to be. Here are some simple tips you can apply to get started. First, follow the 50-30-20 rule every time you receive your paycheck or your allowance. 50% goes to your needs, 30% goes to your wants, and 20% goes to savings. Second, pay yourself first. Make sure that the first thing you do is set aside 20% for your savings. This will ensure that you don't forget about your savings fund and you stay true to your budget. Third, track your expenses. You can use mobile apps like Expensify, or the classic pen and paper, or your very own spreadsheet. Fourth, stop impulse buying. Make sure your purchases are purposeful and well thought out. Found something on Shopee or Lazada? Add it to cart, but let it sit for a few days before you check out. If you still need it then, don't forget to add discount codes and free shipping vouchers. Lastly, build an emergency fund that will help you sustain your lifestyle for 3 to 6 months. Being proactive now will go a long way in the future. it's always better to be safe than sorry. Once you've saved up enough to build an emergency fund, the next step moving forward would be to make your money work for you through investing. In investing, you commit money in order to earn a financial return. Investing is your tool to beat inflation, the inevitable decrease in the purchasing power of your money. To illustrate this, think of the Big Mac. As of March 2021, a Big Mac costs 149 pesos. With 1,000 pesos, you could buy 6 Big Macs. That doesn't sound so bad. But in 2003, a Big Mac was only 65 pesos. 1,000 pesos could have bought you 15 Big Macs. That's 9 less burgers for your 1,000 pesos. Because over the past 18 years, the purchasing power of your money decreased due to inflation. Investors usually come up with their strategies based on their goals. It could either be for capital preservation or capital appreciation. Capital preservation entails prioritizing preserving the value of your money over time and preventing loss. In capital appreciation, you want to do more than just preserve. You want your capital to increase significantly over time. If your goal is preservation, you'll likely want to choose the safest investments. But if you want your capital to appreciate, you'll have to take on more risks. But what does investment risk entail? Risk is highly correlated with return. The larger return you expect, the more risks you must be willing to take. But if you want to play it safe, then you'll have to expect lower returns. There are many investment options available. We have bonds, wherein essentially we loan the government or private entities a sum of money in exchange for returns through interest payments. Bonds are low risk with low returns. Investing in stocks, on the other hand, is purchasing ownership stake in a company. You profit from stocks by selling them at a higher price than what you initially paid, or through dividend payouts for the shares that you own. Stocks can be riskier, but they also have greater potential for returns. Funds pool money from different investors to buy various assets and build a diverse portfolio. Funds are generally lower in risk and returns than individual stocks. If you want to learn more, make sure to check out our upcoming videos where we will discuss more extensively the different investment options. Now that you know more about the importance of saving and investing, here are some tips that you can apply. First, start early. Investing early gives your money more opportunities to grow, especially with the concept of compounding. Not only does your money earn interest on your principal, but you also earn interest on interest. So, if you invest 5,000 pesos at 10% compounding interest rate, not only do you earn 500 pesos as the interest payment, but you also earn 10% interest on that 500 pesos at year 2. Next, make it a habit. As you get more into investing and have already done the necessary steps to actually be able to invest, you may be wondering what sort of trading or investing strategy you can do. And while you may be developing your own strategy, a common strategy to start with is peso cost averaging, where you put a set amount of money to invest in regular intervals. For example, you may decide to put in 1,000 on your investments every first Monday of the month. You regularly do this regardless of what's happening in the market, whether it's considered to be in the highs or the lows. Given that it's fairly difficult to predict the market, you may be able to minimize the risk as you spread out the timing of your payments instead of putting them in one go. This strategy is especially recommended for people who lack the time and expertise to research and study the market. Lastly, monitor and enjoy. Investing, after all, is there to help you achieve your financial goals, whether it's to achieve financial freedom, accumulate wealth for retirement, or generally just make more money. Stressing too much about your investments to the point that your emotions cloud your judgment can be counterproductive. On a final note, financial plans can look different for everyone, especially as people set different goals for themselves and begin at different levels of resources. And while there may be claims that this particular financial plan may be better than the other, just remember that the worst financial plan is not having one. I hope this video will help you get started on your journey to financial independence. For more resources, check out the links in the description box below. and visit Pisopedia's Facebook page to see more of our content. Don't forget to like and subscribe.